Victor Jones. For the next hour, we are going to be talking everything options, stock options, futures options, options, whatever you guys got. Call in your questions, and we'll be answering them, obviously, for the next 55 minutes. As a quick market update, we've actually had, what I'll call a relative rally over the last couple of minutes here. We've rallied from about, a little bit 5 1/4 down to about 3 3/4. The S&P 500, 1248.25, down about $4 on the day. The Dow Jones, 12,016, down $44, still holding the 12,000 number. It seems like every Tuesday we talk, we're hanging right around the 12,000 number, and the conversation is, will we hold it or will we break it? And interestingly enough, we just keep seesawing to one side or the other without much conviction. The Russell 2000, 729.10, down $4.70. And, of course, we've got to talk about the commodities here. Gold, 1777, down about $1.20. Not a huge move in gold today. Interesting, obviously interesting action in the overnight session, which we'll actually talk about here in a little bit. Crude, 98.84, up about 70 cents. So again, broke through the 98 level, and we're now knocking on the 99 level here. And we'll kind of see what happens. Obviously, quickly approaching the $100 mark again. Actually into the holidays, so kind of an interesting market move there. Bonds up a few ticks, notes up about 5 ticks. And obviously we've got some earnings plays out there today. So that being said, obviously we want to talk just quickly, give an update on the VIX as we tend to do. As you guys all know, I'm kind of a VIX junkie, a volatility junkie. We're at 31.83, up 70 cents on the day. So from a VIX perspective, only up about 2.25% for the day when the overall market's down, just a couple of bucks, not even a percent, maybe 1/4% or so in the spiders. So with that, guys, feel free to give us a call. As always, our lines are open, and we'll be looking for those calls. Obi-Wan, if you could do me a favor and just post that number in the Tiger Den for all of those viewers as well. So this morning, before we get started on just a few of the movers this morning, obviously we had retail sales this morning. For October showed a little bit of growth this month, and I think from a market's perspective, it was really the first time we saw that since maybe May of this year. So interesting that we kind of got some of those positive numbers from a retail sales perspective, and still the market obviously not showing much conviction on that news. And again, we had another report on wholesale prices that those actually fell during October, and gasoline prices dropped as well. So interestingly enough, you have this concern over inflation and kind of what our dollars are going to be buying, especially into the holidays. And retail sales obviously are going to be the focus into the holidays. I mean, Black Friday is quickly approaching. So the strength of retail, or the retail numbers, at least in the month of October, is at least promising as we head into the end of the year. Obviously, we have November expiration quickly approaching. We are 3 days away from expiration in November. So clearly, as we talk about options, typically you're putting on those option positions maybe 4 to 10 weeks until expiration. So typically, and as you all know, options decay fastest in the last 45 days of the lifespan. So you're typically looking to put on those option positions about 4 to 10 weeks from expiration. And what does that mean? Well, typically we're looking to take those out, make it really, really simple rules here for everyone. You're looking to take those positions off 4 to 10 days into expiration. Well, why is that? Well, in the last couple of days, basically after today, on Wednesday, Thursday, and Friday, you're going to start to see the spreads, those option spreads, widen out a little bit. And why would that be? Well, in the last 3 days of expiration, it's almost, it's a little bit like Hotel California. Easy to get in, hard to get out. And the reason for that is, there's not a lot of liquidity there. People aren't putting on new positions in that expiring month because the risk to reward is not there for a lot of people. In addition, there's too much gamma risk to put on positions in the last week to expiration. So people could just as easily get that premium by putting on a DECE position or December position with 31 days versus the NOVE position. So we're going to talk more about that, adjusting, rolling your positions. If you've got a position into expiration, please give us a call. Let's talk about it. We've got a call on the line. Ron from Dallas has a question on scanning. Ron, you're on the air.
Thanks, Vic. I was watching a couple of your seminars back, I believe, on 10/25/10, and maybe another one a week or so after that, using the ThinkScript to scan for stocks. And I'm looking for some good stocks with some options to write covered calls on that have a 4% or better return on that. And your seminars there were great, but I only found 2 of them. And then I started reading the manual, and it just goes over my head. I need some more of those seminars. If you have some more there somewhere, you were filling in for a lady on that one.
Sure, yeah, Denise, yeah.
And maybe she had some more later. Oh, you mentioned that there were going to be some from week to week, but I never could find any more.
No, you're absolutely right, and I think, Ron, we with the suggestion that you just gave us, I think we'll pick up and we'll do a few more of those into the end of the year. But what you talk about, Ron, is I think really, really interesting, and I think, if we want to talk about technology, options, expiration, we've got all of that mixed here today, Ron. So I think it's a great question, and you can see I've actually navigated to the scan tab of StockHacker. So if you're lucky enough to be using the ThinkorSwim software, obviously, and if you're joining us through Tiger TV or you're looking at the webcast, you can see the screen share that we have on. And I think, Ron, you bring up an interesting point in scanning for underlying securities that can present opportunity for an options trader. I see so many people out there that might ask me the question, Ron, I want a stock that, or I want to scan specifically for an option. And I think in a lot of cases that may be a little bit misleading. I think typically what you want to do is you probably, Ron, have a strategy, and you just told me usually you're looking to sell covered calls with about a 4% premium or 4% return. And so because you already have that underlying idea, that underlying strategy, you are potentially looking now to narrow down the universe of the optionable underlyings that you can actually utilize your option strategy on. So here's what I'd encourage you to do, Ron. I would encourage you in the StockHacker, obviously, we don't want to be scanning all stocks because what are you looking for? You're looking, obviously, to employ an option strategy on the underlying. So you can see what I'm doing here, Ron, is I'm changing the scan from all stocks to all optionable, which means I'm now limiting my universe to all optionable stocks. Now, the second thing, Ron, you said you're looking to employ covered call strategies. So the first question I would ask you is you probably have maybe a price limit or a price range in terms of looking for a security to actually buy the stock to sell premium against. So could I ask you, Ron, from your perspective or from your strategy, what tends to be the area where you say, all right, this is essentially the underlying price that I'm looking for?
Not over $30.
Yep. And so what I would even say is, I would probably limit it on the downside. And the only reason is once you get down into a $2, $3 stock, the premium or return that you're going to be able to actually sell calls for is really going to be limited. So in this case, not to say it's not available, and if you are investing in a stock that's trading around $3, $2, $4, whatever the case is, and the opportunity is there, I would encourage you, make sure obviously the risk to reward is there, and you're getting enough premium to cover the transaction costs. But for the purposes of this demonstration here, Ron, I'm just going to limit the minimum here at $5. Okay. And here's the other thing that I would do, because what determines the premium that we receive when we're selling an option? So I could sell a one-strike out-of-the-money option, and I could get $2, or in a different stock of the same price, I could sell 2 strikes or 3 strikes out of the money and get the same premium. Well, what's the difference between those stocks? The difference always, Ron, is the implied volatility of the stock. So if the stock has higher volatility or higher uncertainty in terms of price range or price movement, you're going to get more premium for selling an option, or you'll get the same premium, but you'll be able to do that further away from the money. Does that make sense, Ron?
Yes.
So what I'm going to do here is I'm going to also include a piece of criteria, which is vol index, and that's basically a VIX-style calculation of volatility. So it's basically giving you a very, very good idea of what volatility is across the front and back month. And then from that, Ron, you can see basically the distribution here. If you're watching on the screen, you can see the distribution of those prices. And if I was looking for something with a little bit above average volatility, obviously I could move my histograms and just look at those stocks that are above average. But you can see I'm including things with like 350% volatility. In those cases, I'm probably looking at biotech stocks or, something with an upcoming earnings announcement. So what I would probably do in a case where you're looking at covered calls or basically conservative option strategies is maybe limit it to within, that standard deviation or that bell curve of results. From there, Ron, you can show as many results as you want and scan for those. You can obviously sort them by volume. I would definitely put a volume characteristic in there because the more volume in the underlying, the more volume or need to hedge the option position by institutional money managers in the options market, which means at the end of the day, that makes as you're trying to execute a covered call, it means you're not giving up as much edge. So I'd encourage you to put some sort of volume metric on there as well and limit those results. And I think in doing so, you're going to get yourself a nice universe of stocks to start with. And then from there, Ron, we'll hold a future session, and we can, start to incorporate ThinkScript and some other customized metrics. But I do think for what you're looking for, I think this is a very interesting way to start and give yourself a nice universe of stocks.
Okay, can I ask you one more question?
Yeah, sure, Ron.
If, like right now, the market seems to be pretty high to actually buy a stock and write an option on it, so I wonder if during this high market value time, if it would be all right to maybe look at an ETF inverse that would be low at this time.
So here's what I would say about that. If the underlying assumption here, and that's a fantastic question because we're sitting right here at support, resistance, whatever you want to call it, and I think we're coming from the upside, so you have to call 1260 a support area. You have to call kind of this 1250 area, this support area. So I think in terms of looking, saying that, hey, we're a little bit high here, I'm nervous about buying the underlying stock, well, there's a couple things you can do. Let's talk about the option strategy that's there because a covered call, what a lot of people may not be aware of is that a covered call synthetically is the exact same strategy as selling a put. Okay, so if I thought, and I'll just use some examples that are out there, okay? Actually, let's use something like Home Depot because Home Depot came out with earnings today. The expected move was somewhere around $1.60. They didn't overwhelm by any means, and so you've seen a sell-off, but it's held. I think its value. It hasn't sold off significantly. I think the expected move was somewhere around $1.60, and we're somewhere around $38. So close over close, only about a 25-cent move. So it's held its value relatively well. What I would say is if we look together, Ron, if we look in December, Home Depot has a 32% volatility. And so what does that mean? Well, if I look in December and I were to buy the underlying stock right now, $38, I could sell the 39 call at $63. So I'm bringing in 63 cents of premium. Well, if I look at the 36 put, what is that trading at right now? 2 strikes out of the money. Exactly the same price, about 64 cents, which means if I were to sell the 36 put, if Home Depot never gets down to that area, I'll keep the premium. If it does, I'll end up being put the stock at a cost basis of about $35.40. So at $35.40, I'm $2.60 away from the money. Clearly, I have a lot of room between where the market is today and where I could actually end up owning the stock, the cost basis of my stock. So whenever you feel the market may be overpriced, there's always the opportunity to sell puts. And to take it a step further, if you want to limit your capital, because even selling the 36 put, that's probably going to cost me about $12 in capital. So basically $1,200 in capital. Whereas if I were to buy, and this is what I'm saying here, if I were to sell the 36 put in Home Depot potentially and buy the 30 put behind it, basically, I'm not giving up much premium. I'm only giving up 10 cents of premium, but I'm limiting the capital that it takes to put on that trade, and I'm taking it from $1,200 to $600. So there are ways to use, if I feel, again, the market may be coming off a little bit, there are ways to utilize, selling puts, especially in an environment where we have a VIX that's kind of in the middle of its range, right around $32, when the high end tends to be 40 and the low end, at least in this range, tends to be 20. You can get a little bit of premium for doing that. And if you spread this, what people don't realize is you can use spreads to limit your capital exposure, and that just freed up $11,400 for you to go use elsewhere and invest in, short-term conservative plays, or, take and diversify that into potentially an ETF, whether it be a retail ETF, a home builder's ETF, or something along those lines for a little bit more bang for the buck. So I think, utilizing those types of strategies, especially in this type of market where the volatility is giving you some room to play, is definitely a good idea. So I think it's a good point you raised, Ron.
Okay, Vic.
Hey, thank you very much for the call. And again, we'll be looking to do a little bit more custom scanning, webcasts in the future inside of the software. So great question, Ron. Thank you again.
Thank you. Bye.
Thank you, Ron. So I think during that call, again, Ron brought up some great points. One, in scanning, how do we look for potential opportunities out there in the market, and again, utilizing or understanding that scanning for the option itself, in my personal opinion, is much less useful than scanning for the underlying, because if you know your strategy or you have a host of strategies that you can use, then it's more so finding the underlying that has the setup or has the liquidity or has the volatility that you're actually looking for that coincides with your strategy. So again, any calls out there, and that was a great call, Ron, feel free to give us a call at 877-927-6648. Again, 877-927-6648. For all you international listeners, feel free to call us internationally at 727-445-1044. Let's go ahead and give a quick update. Still waffling around the 1248 number in the S&P, 1248 and 3/4, down 375. The Dow, 12,022, up about 5 points from the last quote, down 38 points. Again, gold, 17,777. Is that a lucky number or what? We'll see if it's lucky for the bulls or the bears. And then we also have, obviously, crude, 98.86, up 72 cents on the day. So again, creeping towards that 99 price level. And, I want to take a moment to talk just a little bit about some earnings plays that are out there. So, again, if you're utilizing the ThinkorSwim software, you can always go to Market Watch in our calendar, and you can just sort, obviously, by earnings, and you can look at what's actually happening today. As you know, there's a couple of names out there today. Obviously, Home Depot coming out. We have Walmart, obviously, with their numbers. And, we also have the ability to look at what's happening throughout the rest of the week. So not just today, but what's happening. I think we've got some interesting numbers here coming out throughout the end of the week. Limited Brands, so another retailer is going to be coming out with some numbers. Tyco's coming out with some numbers. And these are all tomorrow, obviously. So those are going to be some of the bigger earnings for Wednesday. And I think on Thursday you have a couple of plays here in terms of Sears here, SHLD. We also have, if we look through here, I don't know if there were any other retailers there, Marvel, but that's not really. So really, I think that's going to be the bigger one on Thursday. And so I wanted to take a moment and let's just talk a little bit about Sears, because it's showing some relatively speaking, or relative to the rest of the market, Sears has a really, really high implied volatility. I say really high, but the rest of the market, or the S&P 500 today, has a VIX reading or volatility reading of about 32%. And, when we look at Sears, its front month vol is 113%. Now we can't, that's difficult because a lot of these options, you can see those out of the money options are no bid at 15 cents and no bid at 14 cents. So really what that does, you can see the implied vol numbers of those far out of the money options are giving some really, really large readings at 190%, 172%. But the real volatility is somewhere around 130, and the back month right around 75%. So relatively speaking, Sears is giving or presenting some really, really interesting vol in the front month versus the back month. And so again, what's always interesting where you have that kind of that increased volatility in the front month versus the back month, there's always the question is, well, what do you think about a calendar here? And I think, again, just as always, it depends on the directional move. And so you always have to take that into consideration. So with Sears, the options are essentially pricing a $5.15 move. Obviously, that's just magnitude of direction. We can't call the direction. It would be up to for us to do that. But the options are priced with about a $5.15 move on their earnings event coming up this Thursday. So at a $70 stock, that's a pretty interesting move that could bring us anywhere from the $63 level up to basically the $73 level. So in a $10 range from $63 to $73. So what then is kind of interesting here is that we are priced in 2.5 strike increments. So the ability to do something, and I'm going to show everyone, I'm going to sell a front month straddle. I'm going to sell a front month strangle, and I'm going to buy a back month strangle. And I want to show everyone essentially what this looks like. If I were to sell this 72.5 call at $1.27, and I sell this 62.5 put for 96 cents. And if we go in the back month, you'll see the $60 put trading for $2.70, and you'll also see the $75 call at $2.33. So I want to show everyone exactly what this looks like on our trusty risk profile. This is what's called, for everyone out there, a double diagonal. And again, if you're new to options trading, it's interesting because it's a four-legged strategy, so it's a little bit more complex than your typical vertical spread or your covered call or selling a put. But if you can see what I'm doing, if you're watching my screen, if not, let me call out the trade so that you understand what we're doing here. We have sold in November with 3 days to expiration. We've sold the 62.5 put and the 72.5 call. And we've also, in December, in the back month, we bought the 60 strike put and bought the 75 strike call. So essentially we're 2.5 strikes wide on either side. It's going to cost us $2.44 to put on this trade. So again, the risk here is $2.44, so $244 for every one time you actually put this on. So again, what did we say? Well, we said that the potential here in Sears, given today's option pricing, is that the underlying stock will move about $5.14 in either direction. So where does that put us? $63 on the downside or $73 on the upside. So if I could, for everyone out there, just go ahead and plant this right around 63, plant this right around 73, you can see the profit points of this potential strategy almost align perfectly with basically what the potential range of move is. So if we have an extreme range off to one end or the other, this particular strategy, would given current volatility, would look to be potentially profitable. But what tends to happen, and what we always have to keep in mind, is what's going to happen as soon as Thursday comes, to volatility in that front month. Well, basically, it's going to come out a good amount. Maybe let's call it 25 to potentially 30%. And in ThinkorSwim, you do have the ability to basically play with these different volatility numbers. So I'm showing you here, if you didn't see it, I've just clicked on the wrench and the More button so that we can look at, taking out vol in just the front month. So just taking out vol in NOV to see what effect that has on our position. And you can see it kind of actually moves our profit points on expirations up just a little bit. We talked just before, we just almost said this a few minutes ago, that a lot of people aren't, taking new positions in that front month. But I think when you have an earnings play, this front month expiration is exactly like a weekly option, and essentially that's how you have to look at it. These are essentially weeklies as we go into expiration, and so you do have a little bit of room to play, and you've taken a position in the back month essentially, but obviously that decay, as long as we stay within that short month strangle that you've created in the front month, obviously that's what you're looking to happen so that you take in the full amount of that decay. In the back month, obviously, you might have an adjustment as well, so you can actually play with what that does to your position. So we're most likely going to have, a contraction of vol in that back month in December from 75% to potentially 73 all the way down to 70. So you can see I've taken it out 8% at the worst case to kind of see what that does to the position. You can see still it aligns pretty well to what the expected expectation might be. So I think what we'll do here is we'll go ahead and we'll send this one off, and we'll actually see how this one actually performs, into earnings on Thursday. That being said, guys, we had a great call from Ron on scanning. Why don't you give us a call on any earnings plays, on any expiration plays or questions? Give us a call, everyone, here at 877-927-6648. So I think it's a good opportunity to talk about rolling here. Basically, if you have any positions on in the front month, you're most likely going to be looking, at how to essentially roll those positions into a back month. Should I be looking to close my position or roll it to the next month? As a quick market update, we've had just a pretty big swing here from down 4 level up about $1, so about a $5 swing here in the SPOOs. 1253.25 where we're trading up $1. The Dow here is still 12,064, so we're up about $4, so about a 54-point move in the Dow just in the last couple of minutes. So we'll keep our eyes on any news that's out there here, guys, and see what the purpose is of that swing. But if you've been watching the VIX, it actually kind of led that rally. 31.28 is where we're at now, only up 15 cents on the day. As a quick update, I know we haven't talked too much on the dollar. I think it's a shame because, obviously, with everything that's happening around us in Greece and Italy, so on and so forth, and I won't beat, basically a dead horse with a stick here, but we're at $1.3545, down about 90 pips on the day. So. As a quick update there, gold, everyone, 1780, up $2 on the day, so relatively flat here in gold. So let's we're taking a look and we're going to see here what the news is. We're at 11:30, so I don't think we actually had any numbers, but we'll take a look. I think we should probably, when we talk about rolling, always look at Apple, right? Because there's so many people out there that have, at least have your eye on it, if not trading it or looking at potentially putting on a new position. But I think Apple's move here lately has been really interesting. $387.88, up $8.60. And if you look essentially at the history of Apple, it's just like the market. Just as the market is struggling at this 1250, 1260 area in the S&P and the 12,000 area in the Dow, essentially all we're doing in Apple is moving right around this 400 area, and about 3 days ago we had a very strong move off the 400, but you're seeing today a little bit of buying conviction at the 380 level. But I think what does that mean, on a relatively flat day? I think if you look at what the upside potential is, obviously going into the end of the year, let's look at what open interest is telling you into expiration. And it's kind of this old myth that well, not a myth. Basically, stocks like Apple, Baidu, Google, their pin risk is greater than most stocks. You might say that there's been a greater occurrence of Apple, Google, and Baidu pinning at a certain strike. And what do I mean by that? Well, we're trading at 387.77 today, and clearly there's no 387 strike, but there is a 390 strike. There is a 385 strike. So what you could possibly see here as we wind down into expiration is that Apple, Friday come 3 o'clock, we're trading right at 385. We're trading right at 390. In other words, those butterflies out there are pretty interesting risk-reward scenarios in stocks like Apple and stocks like Baidu and stocks like Google. And again, the old myth is that you kind of look for the highest open interest in terms of where that potential pin risk may lie. And the reason for that is, if people, institutional money managers, retail customers, whoever it is, if you have a large option position at a certain strike, you have to get out of that position either by rolling the options, and when you roll the options, you obviously are going to move the market, or you'll need to buy the underlying stock, sell the underlying stock, depending on if you have reversals or conversions on, into the next month. So with all that kind of manipulation, I want to call it market manipulation, but it's position manipulation moving into the next month, you have this tendency to pin at areas where the overall market has the highest vested interest. So if we look at Apple in November, you have the 385 and 390 strikes with very, very similar open interest, at least on the call side. And on the put side, some really interesting activity at the 380 level. Open interest of about 15,000 there. Now we've had 11,000 puts trade today. And it's going to be very, very difficult to see what that volume is. Is it opening positions there at the 380 level, looking for a quick move to the downside, or a quick retracement, or is it more or less closing positions there to really close out a lot of that open interest? So we'll kind of see what's happening there tomorrow. But again, as you all know, open interest only published one time per day. So today, essentially, the biggest numbers that we really have to look at are the 385 and 390 strikes. And looking at those, again, if you were potentially looking at, hey, that's great information, but how do I actually potentially use it or put it into practice? Well, if you were to, in the ThinkorSwim software, and if you're looking at the 385 call strike, for instance, simply going to buy a butterfly in this environment with this volatility, with this many days to expiration, it'll cost you 80 cents to do, approximately 80 cents. And if we analyze the reward potential for every one time you put that on, if Apple pins right at the 385 strike, you're looking at potentially about $380. So again, you're risking 80 to potentially make 380. So an interesting risk-reward perspective, and we're right around the 387 mark with high open interest at 385 and 390. So it could be an interesting play, but keep in mind that is something that you might supplement a position on. That's kind of like going out there and buying one of those deep out of the money calls. It's a lottery ticket essentially. But again, in stocks like Apple, and stocks like Google, and stocks like Baidu, they do present interesting risk-reward scenarios because you do have a higher occurrency of pinning at a certain strike. So those butterflies open up right on Friday afternoon, and present an interesting risk-reward scenario. I'll bring you through what this would actually look like, because you would only make or stand to make this $400 or $300, whatever you want to call it, only on expiration. So we actually have to expire right at that strike. So what I want to show you is really what would happen, because are you really going to let this expire hoping that we expire right at 385? Absolutely not. What you would actually do is most likely sometime Friday or Thursday or Friday look to close out that position. So essentially, come Friday, without expiring and depending on volatility, it's really a one-to-one type scenario. Risk $80 to potentially make anywhere from 80 to 120 is where you might see that widen out too towards the end of the day. So just putting that out there again. We've got a couple requests. G7 in the Tiger Den asked to talk about using bull put spreads versus naked puts. So we talked about that just a second ago in terms of Home Depot, but let's look at some other underlying securities. So if we have any callers on the line, or if you want to type that into the Tiger Den, I'll take a couple examples here and we'll look at some bull put spreads versus naked puts, because in my opinion, it's one of the most fascinating ways to save capital. G7 says you pick. So I think we had Alan in the chat room asked to use AT&T here at this level, trading at 29.18, really flat on the day like today, basically neutral, not much movement here. And I think this one is actually going to be it's tough in November, obviously. Let's look in December. Okay, so here's a little bit of premium here. So what I'll do is add a few metrics here, and I'm using the ThinkorSwim software to add covered return and max covered return. So we're actually going to see on the put side. So on the covered return side, when we're talking about selling puts, if I were to sell, let's say the 29 strike here, I would bring in about 58 cents of premium, which basically from a covered return perspective, as you can see on the screen if you're watching the screencast, is about 22.5%. So if I'm at a $29 stock, I'm selling it at about 58 cents. So I'm going to bring in 58 cents of premium. From a covered return perspective, that's 22.5%. Well, what does it cost me to do that? And if you'll look here, I'm going to actually load up a sell of the 29 put at AT&T for December. And you can look, if I hit confirm and send, what amount of capital does that cost me? And I'm just doing one here. That's going to cost approximately, let's call it $900 in buying power. No. It can't be right. Yeah, that's about right. So about $900 in buying power. Well, if you actually look at the potentials of those out-of-the-money puts and how much they're actually trading for, you can see that we can give up a little bit of premium and basically cut that in half. So again, I'm selling the 29 put, and basically I have to put up the amount of capital to actually purchase the stock at 29. Now I'm going to bring in 58 cents of capital, so basically I would only have to put up about $28.42 or so. And if you're using margin, clearly you're only going to have to put up a third, which is why our buying power is only looking at about $900. Now, if instead of just selling the 29 put, I go and I buy, let's say, this 25 put behind it, G7. So what has that done to my premium? Instead of taking in 59 cents, okay, I'm going to take in 50 cents instead. But what has that done to my buying power? If you'll take a look, I now only put up $350 of capital to put on this trade. And now, why is that important? Well, if we look at the probabilities of expiring, the probabilities of expiring below the 25 is essentially, it's 7%. I mean, it's a 1 out of 10. It's a long shot. It's a 40-point horse. It's whatever you want to call it. But basically, it's a 7% opportunity that we actually expire below 25. So what that means is I'm just buying something that's really not necessarily protecting me. In essence, it is, because I'm limiting my risk to $400. But the probabilities that we actually even trade down to 27 are only 1 in 4 basically, or 1 in 5 actually. So you can actually see that in terms of bang for your buck, if you want to call it, I was looking at 59 cents on $900 of capital versus 50 cents on $350. You can see how I've essentially leveraged my capital from a percentage standpoint to bring in more capital per dollar of buying power. And so when I'm looking at the difference between a naked put and a bull put spread, sometimes it's based on the volatility of the underlying stock. For instance, in Apple, a stock like Apple, where it can definitely move, and maybe I'm selling something that's pretty close, maybe at the 380, 385, or whatever the case would be. Apple definitely has the potential, and it has shown the potential to move, $10, $20 in a day, which means it could easily blow through those strikes. And so in those cases, you're putting on the spread to protect your risk. But there are other cases, something like AT&T, something like Microsoft, those stocks that maybe don't have an event and tend to be a little bit less volatile. If you look at AT&T, 24% implied volatility versus the overall market at 32%. So again, less volatile relative to the rest of the market from an implied volatility standpoint. Now, their beta, and I think beta is really important to understand. The beta of AT&T is right around 1, which implies over the last 5 years, its movement from a percentage standpoint is relatively close to the underlying market. But at least the options market is expecting a little bit less volatility over the next year, and even if you break that down in the next month, to be less volatile than the market. So what that tells you is that even though it's less volatile and less likely to blow through your strikes, you are then looking at the spread as a way to limit your capital exposure. If I told you you could make the same amount of money using half of the capital, which one would you choose? Would you choose to put up all the capital, or would you choose to put up half? If I told you you could make more money per dollar by spreading something versus selling it naked, which one would you choose? Well, clearly you choose which one offers you the better potential from a risk-reward standpoint, in addition from reward to buying power. So I think you bring up some really, really good questions there, and looks like you said this is excellent. I'm glad that you feel that way. But I think that's so important that people really look at spread trading, and they only look at it as a way to limit risk. And I think if for all of you that are out there and you're selling puts, and this goes for all of you that are actually utilizing covered calls, because the only difference between a covered call and a naked put, the only difference is that if you're going to do a naked call, you should have already owned the stock. Basically, if you own the stock and you're looking to potentially limit the upside return and bring in some income, then you would do so by selling a call. If you don't own the stock and you think it'd be an interesting long position, and you think, once I get in the stock, I'm going to bring in some more premium or decrease my cost basis by selling a call against it, if you don't own the stock, it's much more interesting to utilize or look and evaluate the naked put. Why? Well, one, most firms might charge you for, if you buy the stock, you're going to get charged transaction costs, and if you sell the call, you might get charged transaction costs. If you're selling a put, which is essentially synthetically the same thing, you would limit your transaction costs, which it may not be much to you, but over the course of a year, and when you're evaluating your performance, that couple of percentage points on saved transaction costs may be the difference between being in the market and underperforming. In addition, it also gives you the ability to basically evaluate the difference between a naked put and looking for a spread position. And those spread positions can sometimes offer a very interesting capital savings. So great question, T7. Trade says limited profit potential in selling puts, and I would absolutely agree with you. So here's the difference that I want to actually bring up. So if we look at the difference, I'm selling puts, which is a bearish move. I'm selling puts, which is a bullish move, but also limited in my reward potential. So then the opposite argument is that by buying calls, I am not limiting my my upside potential. But I want to look, and I think that's a really good point, I want to look at the difference between the two strategies from a probability standpoint. So if I'm selling, in this case, let's just call it the 28 put, okay, in AT&T. Say I'm selling the 28 put. If you look at the probabilities that we expire from now into December below 28, it's about 30%, meaning as a seller of that, there's a 70% chance that I actually keep the premium and that we stay above that mark. But as trade mentions, I would never bring in more than 30 cents or 31 cents, whatever you could squeeze out of that execution. On the flip side, if I buy a one-strike out-of-the-money call, right, because we're trading at 29, I sold the 28. If I buy one strike out-of-the-money call, again, the probabilities there that we expire above 30 are 26%. So if I'm long that option at come expiration, there is a 26% chance that it's actually in the money. Well, do I need the option to be in the money come expiration? Absolutely not. That won't help me at all because I just paid 28 cents for a December 30 strike call. So I actually need it on expiration to be trading at the strike price plus the premium I paid for the option. I need it to be trading at $30.28 or more to actually break even. At 30.28, I am break even, and then any penny above that, I'd actually be making money. So you can see I needed to go to 30.28, and the difference between these two strikes actually is kind of tough to call on what that would be. But what we're saying here is that there's on this side where I actually have unlimited profit potential, the potential to actually break even or make money on expiration, that is only 1/3 or less than 1/3. On the other end, where I've limited what I can actually make, I now have a 2/3 chance of being successful. So you always have to, and the market always is, a trade-off between risk and reward. You're never going to find something that has unlimited reward and limited risk. Well, I should say it this way, that has a high probability of success. You're never going to find something that has unlimited reward potential and a high probability of success versus the opposite strategy where you have limited reward and a good percentage of success. So I want to basically proposition that to everyone and position that out there so that we're all thinking along those same lines and we're thinking about probability. So for those of you, I think we've got about 5 minutes left here in the show. I think we've talked about a lot. I mean, in 1 hour, we talked about scanning. We've talked about looking for underlying securities that would potentially be conducive to options trading, specifically covered calls. We talked about the difference between covered calls and selling puts. And obviously the difference there, again, is if you're selling a put, obviously you're not going to receive the dividend. If you're long a stock and it's a dividend payer, being long the stock, clearly you would take in the dividend. But what happens is in selling the call is discounted by the amount of the dividend. Same thing by selling the put. Well, the put premium, basically, we know that the stock is going to drop by whatever amount of the dividend. So it's built into that put, so you do kind of receive a little bit in terms of the premium, or it's built into the premium, so you don't necessarily receive it. But that's one difference. But we talked about the difference between covered calls and selling puts. And in addition to that, we've basically talked about selling naked puts and the difference between selling those naked puts and basically selling put spreads in order to shore up capital and limit risk. But more importantly, everyone out there, to understand that it's a way to limit capital exposure. So with that, we'll do another quick market update. We've got the SPOOs at 1253.25, up 3/4 of a point, up 75 cents. We have the Dow. We have the Dow at $12,066, up $6. So a little bit of a divergence there. Not really. I mean, actually, we're probably where we would expect to be. The VIX is 31.18, only up 5 cents. So you're seeing the VIX basically coming off to almost unchanged on the day. And, where we started off earlier here today, we're up about 20 cents in the VIX, and we've now climbed down all the way to 31.18. Lastly, in commodities, obviously, 99.14 and crude oil up 98 cents. So crude has broken the $99 mark. So approaching $100 into the holidays is going to be interesting here, especially with what the euro dollar is doing. We're at 135.35, up about 99 pips. Excuse me, guys. It's been a long hour, and. In terms of the Russell, we're at 735.90, up $2.10. So with that, we've got about 3 minutes left. Let's just go through a couple of charts on the day. We've got Apple here at 387.50. We obviously have Sears here at 69.10, again an earnings candidate for this Thursday, and we'll be looking and we'll continue to be looking at the retailers and how they're performing, especially as we gear to go into the holidays here. And everyone's looking at Black Friday here next week, so it'll be very, very interesting. Again, retail sales numbers here were actually a bit encouraging this morning. Wholesale numbers were down as well, which is kind of telling us that inflation is not as much a concern, at least for the last couple of months, than maybe we thought it was. So Home Depot, we've also got Walmart out, and I think this is pretty much the story here. I mean, Walmart at 57.40, so we're down about $1.50. And if you listen to the radio show that we had, about 5-minute update yesterday with Tom O'Brien, he asked me, hey, what might we talk about here today, or what might we be looking at? And we said Walmart and Home Depot. Home Depot had about a $1.60. If you looked at the options, we were expected it to move maybe about $1.60, and you can see it kind of held its range. Walmart, on the other hand, we expected to move about $1.54, and you can see on the day we're at down $1.50. So clearly, lots of move there in Walmart, but it moved almost exactly what we expected it to do, and it's kind of foreshadowing what the expectation might be here in Sears. So again, we constructed kind of a neutral position. But the weight of that, and you can see the trend of Sears over the last couple of months is actually to the downside, and you have some of the retailers here, at least Home Depot and Walmart, not coming out with great earnings on the bottom line. So with that, everyone, we will be watching, as always, as it seems like we're doing over the last couple of months, the 1260 area in the spiders and, in the SPOOs, and we'll be watching the 12,000 area in the Dow. I want to thank everyone for calling and typing in your questions. I think it was a great section. I want to, thank TFNN, and thanks for listening to the Option Hour. We'll catch you next Tuesday and every Tuesday from 11 to 12 Central here on the Options Hour. Thanks, everyone.